There's been some significant movement in the financial world lately that's really caught our attention. We're diving straight into it today because the US dollar index has, well, recently dipped below the 100 mark,
Mm,
a level that seems to be making quite a few waves.
mm,
So, what's behind this shift in the dollar's value?
right.
What's causing it to weaken? And what could this mean for, the U.S. economy and investments around the globe? That's what we're aiming to understand in this deep dive, looking at the factors driving these changes.
Absolutely. And the fact that the dollar index, which, basically tracks the dollar against other major currencies, has fallen below 100,
Yeah.
that does signal something notable. It suggests a changing dynamic in how the dollar is perceived globally. And as we've seen in the sources, there's this kind of building expectation that the weakness might continue.
Okay, so we're seeing this dip. Let's try to figure out what's fueling it. A key factor highlighted in our material is the impact of the trade war and the
Mm.
tariffs that were put in place. The argument is that these tariffs are acting to, quote, punish global exports and, maybe more significantly for us today, are destroying the flow and demand for dollars.
Mm,
Can you help us unpack how tariffs can actually do that to a currency?
sure. Think about it in terms of international commerce.
Yeah.
A huge chunk of global trade happens using U.S. dollars. So when the U.S. imposes tariffs on imported goods, it can really disrupt those established trade patterns.
Right.
If other countries find it harder or just more expensive to trade with the U.S. because of tariffs, or if U.S. goods get pricier for them, well, their need to use and hold dollars for those transactions, it just naturally goes down. One of the analyses we looked at suggested that even a, say, noticeable percentage drop in global trade involving the U.S. could lead to a proportional, maybe even bigger drop in dollar demand.
That makes sense. Less buying and selling between nations involving the U.S., less need for the currency used. Simple enough. And one of our sources paints a pretty vivid picture, doesn't it? Several things happening at once. Efforts to reshore industries, trade with China cooling off, other countries maybe reducing reliance on U.S. goods,
Mm-hmm.
all while the dollar itself is losing value. It sounds like a really complex mix.
It is. It's definitely multifaceted. Trying to, revitalize domestic manufacturing while also putting up barriers to international trade and maybe straining relationships with key partners. That can create some serious economic headwinds. If other nations start diversifying their trade, becoming less dependent on the U.S. and the dollar, that's logically going to put downward pressure on the dollar's value.
Which brings us to another really big point from the sources, investors seemingly moving away from U.S. assets. Traditionally, U.S. assets, especially Treasury bonds, they've been seen as this safe haven, right? During global turmoil, everyone flocks there.
The go-to,
Yeah.
yeah.
But the information we're looking at suggests that might not be happening now. Maybe even the opposite. What's behind that potential shift?
What's really interesting here is this possible erosion, you could say, of that traditional safe haven view, at least for some international investors. A key sign of this is the big jump we've seen in bond yields.
Yeah.
As our sources point out, yields went from under 4% to over 4.4% pretty fast,
Wow.
and even past 4.5% recently. A rapid rise like that usually signals, well, less demand for U.S. Treasury bonds.
Hmm.
When demand falls, bond prices go down, and the yield, the return an investor gets, has to go up.
So, less enthusiasm for buying U.S. government debt. What are the underlying reasons? Our sources mention concerns about just the sheer size of the U.S. national debt
Right.
and the fact that a huge amount needs refinancing soon.
The scale of the debt, plus the prospect of refinancing trillions pretty soon, especially if interest rates stay high. It definitely raises questions about the U.S.'s long-term fiscal health. Investors might be thinking, can the government actually manage this level of debt? And the material brings up a critical point. With yields rising, issuing long-term Treasury bonds gets riskier. The market might demand higher and higher returns, maybe making it just too expensive for the government.
And the potential knock-on effects on the everyday economy sound quite worrying. The possibility of exploding mortgage rates and car loan rates. How do rising Treasury yields cause that?
Well, rising Treasury yields often act as a sort of benchmark for borrowing costs across the entire economy. When returns on government bonds go up, it generally pushes up interest rates for other kinds of borrowing too. Mortgages, auto loans, business loans.
Makes sense.
So it just becomes more expensive for people and companies to borrow money, which can definitely slow down economic activity.
It really does seem like a departure from the norm, like our sources emphasize, where investors usually seek U.S. safety in chaotic times. Instead, the story seems to be shifting towards investors go where they feel they'll get the best return and stability, and the uncertainty from the trade stuff might be pushing money away.
That's a crucial insight, I think. Investment capital is fluid, isn't it? It's always looking for the best risk-reward mix. The trade war adds this big layer of uncertainty about future economic conditions, trade ties, even government policy. If investors see other markets or different assets as offering more predictability or stability, well, they might just decide to move their capital.
And the sheer amount of foreign holdings is just staggering, trillions in bonds, stocks, corporate debt, making up a huge chunk of the U.S. market.
Yeah, it's significant.
And the info we have suggests these holdings are being reduced. We're seeing drops in stocks, the dollar index itself, and bonds. That's a serious outflow of capital.
It absolutely is. When you have that much foreign capital invested, any major shift in those investment choices can have a pretty big impact. A sell-off like that can pressure asset prices across the board and, yeah, potentially add to more economic instability.
Let's dig a bit deeper into that connection being made between U.S. tariffs and the G7 nations' Treasury holdings. It sounds like the sources are suggesting a pretty direct link.
Yeah, the core argument is basically this. As trade slows down between the U.S. and its major allies, the G7 countries, their reason for holding vast amounts of U.S. Treasury bonds might shrink. Think about it from their side. If they're facing hefty tariffs on goods they sell to the U.S., their whole economic relationship gets strained.
Right.
So in that situation, why would they keep holding huge reserves in U.S. government debt when the very trade that often supports those holdings is being hit?
The examples given are quite stark, aren't they? Japan holding $1 trillion in U.S. bonds while facing a 24% tariff on some goods. The U.K. with a huge holding and a 10% tariff. Canada and France, both over $300 billion, facing tariffs of at least 20%. It certainly paints a picture of a weakening rationale for them to keep holding so much U.S. debt.
Exactly. A key reason countries hold another country's debt is often to smooth out trade and investment flows. If those flows are being blocked by tariffs, then the underlying reason for holding the debt gets weaker. And these G7 nations, they're major global players. Their decisions on U.S. treasuries carry a lot of weight and can definitely influence wider market sentiment.
So, okay, besides the direct tariff impact, what other reasons are being cited for this apparent drop in demand for U.S. treasuries?
Increased volatility in long-term bond yields is a big one. The information we looked at mentions big moves of up to 8% in both 10-year and 30-year yields.
Yeah, 8% moves. That's not exactly stable.
Not at all. And that kind of volatility makes these bonds less attractive for investors looking for steady, predictable returns. It adds a level of risk that some might just not be willing to accept, especially if they see more stable options elsewhere.
So U.S. treasuries maybe aren't seen as the super solid, low-risk bet they once were.
Precisely. And as we touched on, big reductions in foreign holdings can actually make this worse by pushing yields even higher. That J.P. Morgan estimate our sources mentioned, every $300 billion drop in foreign holdings potentially pushing the 5-year yield up by, was it 33 basis points?
Yeah, something like that.
It really shows how interconnected global investment is. Ultimately, the instability and uncertainty from the tariff situation seems to be a primary driver behind this lower demand.
Which naturally brings us to the consequences of these rising treasury yields. It's not just about bond investors, is it? There are wider effects on the U.S. economy.
Absolutely, not just investors. Rising yields mean higher borrowing costs for the U.S. government itself. It gets more expensive to finance the national debt. Our sources use the word unsustainable, which really highlights the potential long-term risks if this keeps up. More of the government's budget has to go just to paying interest on the debt, potentially leaving less for everything else, infrastructure, defense, social programs, you name it. The fear is that these policies could genuinely contribute to an economic slowdown, maybe even a recession. That would hit American households and workers through higher borrowing costs, potentially job losses, and just more economic uncertainty overall.
Okay, let's switch gears a bit and look at the promises made during the trade war versus what we're actually seeing economically based on our sources. Seems like quite a gap there.
That's a key point, yeah. The initial expectation, or at least the rhetoric, was that other countries would sort of just capitulate to U.S. demands.
Right.
But the reality, as the sources show, is that big economies are fighting back, putting up their own tariffs, finding other ways to respond, and similarly, the hope that bond yields might drop. Well, instead, they've been shooting up. Pretty much the opposite of what was likely intended.
And those Yale study findings referenced in our material, they paint a pretty grim picture. Projected drop in U.S. real GDP this year, higher unemployment, fewer jobs, and a long-term drag on growth even out to 2035. Those sound like serious negative consequences.
They really are. These projections suggest the trade war is having a real, tangible negative effect on the U.S. economy, kind of directly contradicting any claims of benefits. And the finding about a long-term GDP reduction really underscores the potential for lasting economic damage from these policies.
Plus, the effective U.S. tariff rate has reportedly jumped dramatically, maybe close to 25% if people can't easily find substitutes. That's a huge price hike on imports for consumers and businesses.
It is, and as our sources point out, for consumers, that often means higher inflation, that big sticker shock people might be starting to feel.
Yeah.
When things cost significantly more, people tend to cut back on spending, right? Which then hurts businesses and slows the economy further. And all the uncertainty from these changing tariffs makes it incredibly hard for companies to plan ahead or give reliable earnings guidance.
China's response to massively increasing import taxes on U.S. goods, essentially blocking a lot of U.S. exports, costing American companies billions, shows they weren't backing down.
Exactly.
And it wasn't just China. Other partners like Canada also put tariffs on U.S. goods, making it harder for U.S. companies to just sell elsewhere.
It really shows how linked the global economy is. Trade isn't usually a one-way thing. When one country throws up barriers, others often respond. The fact that other key trading partners also hit back limits the ability of U.S. companies to just reroute exports and avoid the pain. And the apparent lack of willingness from either side to de-escalate suggests these economic headwinds could stick around for a while.
Okay, finally, let's tackle why a declining dollar just by itself can be bad for the U.S. economy right now.
Right, because normally you might think a weaker currency helps exports, makes imports pricier, maybe boosts domestic industry.
Yeah, that's the usual theory.
But our sources emphasize a really critical factor for the U.S. A big chunk of what we consume, around 15%, comes from imports. And the U.S. currently doesn't have the industrial base to quickly replace all those imports with stuff made domestically.
So unlike some other places, a weaker dollar here doesn't just automatically spark a boom in domestic production to fill the gap.
Exactly. Instead, the main effect is that U.S. consumers just end up paying more for the imported goods they still need and rely on. People are basically forced to spend more money for the same stuff, which fuels inflation. Our sources suggest potentially at least 10% inflation from this. That puts a real squeeze on household budgets and cuts down on overall spending power.
And the analysis we looked at suggests this puts the previous administration in a really tough spot, especially with that temporary pause on more tariffs.
Precisely. Starting the tariff hikes, again, could make things even worse, maybe triggering a serious drop in consumer spending as prices climb higher. But just pausing doesn't fix the damage already done by existing tariffs and the weaker dollar. It's a tricky situation, really, with no easy or obviously good options.
So to kind of wrap it all up, we're looking at this tangled web, aren't we? A falling dollar, rising treasury yield showing weaker demand, foreign investors selling U.S. assets. And the trade war and tariffs seem to be a major catalyst driving a lot of this economic shift. It's certainly a different outcome than what was initially promised.
That sums it up well. The different factors we've talked about are definitely linked, creating a complex and, potentially challenging outlook for the U.S. economy.